In our previous video, we looked at the classified balance sheet in more detail. So we looked at what are current assets versus long-term assets and current liabilities versus long-term. So current items are in the 12-month period. So current assets, items we think will convert to cash, sell, or consume within 12 months. Current liabilities, an amount we think we will settle within 12 months. So we break those out on the balance sheet so that the users can see them really easily laid out in that order of liquidity. So they can see how many current assets are available to pay off those current liabilities and assess whether this company that they're looking at is likely to be able to pay off those debts in the next year. A further tool that is available to users are ratios. And in this video, we're going to take a look at the current ratio and the debt ratio. So ratios in general, as I said, they're tools for decision makers that are calculated from the financial statements. And these are used to assess the financial position or the standing or how well that company is doing. And ratios are a useful way to show the relationship between numbers. So just looking at the financial statements and looking at, well, here's our total current assets. So there's the dollar value of current assets. That has some meaning, but when we're able to compare that to something, it gives it even more meaning and more usefulness. So we could look at, say for example, year-over-year comparisons. So if we were looking at revenue, well, did we have more revenue this year than last year? So that's being able to compare something. But ratios are even more detailed because they look at relationships between two or more related accounts. And then we could do ratios over multiple years and even compare those. So these ratios are just a really good tool for users. And they can also, as it says here, be compared against other benchmarks. So maybe against a business or I tried to combine these words, against a competitor, so another business, or maybe the general market conditions or an industry average, or as I said, their own company, but in prior years. Two commonly used ratios, and the first ratios that we will look at are the current ratio and the debt ratio. And you'll see these are the first, but after typically every chapter that we have going forward, we look at a ratio related to that item. So in chapters 5 and 6, we're going to discuss inventory, and we'll look at ratios specifically related to inventory because these are commonly used and they're really useful to help decision makers make those decisions. Okay, so the current ratio. It is a measure of the ability of a business to pay its current liabilities with its current assets. So as these debts become due in this next year, in 12 months, will the company have enough current assets to pay them off or to settle them? So this is one reason we want to break out those total current assets and current liabilities on the balance sheet. So when we go to calculate the current ratio, we don't have to do any math. Instead, we just look at that classified balance sheet and we pull those numbers off of there. So the current ratio, as you can see here, is calculated as the total current assets divided by total current liabilities. So how will the current debts as they become due, will we have enough within this company in our current assets to pay them off? So it looks at this relationship between the two. For the current ratio, the higher, the better, or the better indication the company will be able to pay off these current liabilities as they become due. So higher is safer. It's saying, yes, you have enough current assets to pay off your current liabilities as they become due. So a general rule of thumb is that the current ratio, it says in the textbook, should be between 1.3 to 2. That's that safe range, but not getting so high that we're not using our assets accordingly. So the lowest, or you at least want your current ratio to be at least 1.0. And this means that you have just enough current assets to pay off your current liabilities. So anything lower than 1 is really, really, really risky. It's saying you don't have enough right now to pay off all your debts as they become due in the next year. This 1.3 that's noted, that's just a little safer. It gives kind of that cushion just in case you need to use your cash to pay off something unexpected that comes up that's not already sitting in your liabilities. Now, the reason that it stops or says between 1.3 and 2 is because having a really high current ratio, while that's really safe because it means that you have a whole bunch of current assets, it may indicate that you're not utilizing your cash flow in the best possible way. So if your current assets are really high, maybe you have a lot of cash. Well, if you have that cash sitting there, yes, that's a good thing, but could you better utilize that cash? So maybe you have a loan and you could use that cash to pay down your loan to save off any interest that you would incur on that. Or, for example, accounts receivable. That's another current asset. So if you had a really large accounts receivable amount, that's good because eventually you're going to collect it. But if it gets too high, it could indicate that your customers aren't paying you that quickly. So that gives you something to look into. How can you try and collect from your customers more quickly? So this 1.3 to 2 range, that's where you're safe. And if you have something above 2.0, yes, that's safe, but maybe you're just not utilizing your assets the best that you could. Okay, so let's look at an example of the current ratio. So if you open your textbook up to S4-18, which is on page 211, I'll give you a quick sec or pause if you need to run and grab your textbook. But when you have it open, you'll see that the question says to calculate the current ratio and the debt ratio for Teets Consulting at December 31st, 2020. So we're just going to do the current ratio first, and we'll come back and do the debt ratio. And you see there the balance sheet for this company. So it lays it out. It's a classified balance sheet because it's broken out the current assets from long-term and current liabilities as well. So this makes it much easier for us to prepare or to calculate the current ratio. So we see on this previous slide our formula. So the current ratio, current ratio equals your current assets divided by current liabilities. Take a look at the textbook question. What are our current assets? So we just get to find that because it is classified, it's broken out. If we didn't have this broken out into current and long-term, you would actually have to go do the math and add up which of those items were current assets. So for us, we're happy that we have it broken out. We can see the total current assets is $35,000. And the current liabilities are $17,400. So we're just pulling those numbers off of the balance sheet. If you do the math there, 35,000 divided by 17,400, you get 2.01. And this is shown as times. So 2.01 times. So your current asset are 2.01 times your current liabilities. You have twice as much of those. Or another way that you could read that is that for every $1 of current liabilities, you have $2.01 of current assets available to cover them. So how do you think this measures up? Is this risky? Is it safe? Is it a weak ratio or a strong ratio? So this is strong. Oops, can't spell. This is a strong current ratio. Or it is indicates that it's safe. So we said we want between 1.3 and 2 as our general rule of thumb, so we've met that. So having a current ratio of 2.01, it indicates, we don't know for sure, but it's a good indicator that the company will be able to pay off their current liabilities as they become due. So if this company goes to a supplier and it's a new supplier that they've never worked with before, maybe they're asking for the supplier to grant them credit. So they're saying, we want to buy supplies for you, but we want to buy them on account, and after 30 days, we will pay you. The company or that supplier may request to look at the financial statements, and they would calculate this ratio. And for this company, they would say, hey, well, this is pretty safe. A current ratio of 2.01. Yep, we think this company is going to be able to pay off their liabilities as they become due. So yes, we will grant you credit. We'll allow you to buy supplies on account. If the current ratio ended up being really low, so maybe it was 0.9, well, now the supplier would say, no, that's a very weak ratio. It's unsafe for us, so we're not willing to grant you credit. So that's where this type of ratio may be used. Or it's also likely to be used by internal users. So someone within the company that is judging if they have enough money. So as they're doing the budget, they're trying to figure out over the next year, do we have a good cash flow? Are we likely to be able to pay off these current liabilities? If they calculate something in this 2.0 range, they know they're pretty safe. Okay, the next ratio is called the debt ratio. And this ratio is calculating the proportion or the percentage of a company's assets that are financed by debt. So what percent of your assets did you need to take on debt in order to pay for? The other portion is paid for by the equity side. So either by an owner's investments or by retained earnings that are kept in the company, or that capital amount. So the debt ratio is calculated as total liabilities divided by total assets. And this one is a measure of the ability of the company to pay all debts, so both current and long-term, as they become due. Now for the debt ratio, a lower amount is safer. So this is opposite the current ratio. And one way you can remember that, well, your liabilities are on top and the assets are on the bottom. So we want more assets and less liabilities. So the higher this amount, the worse off we are. So therefore, the lower this ratio, the more safe that the company is. Or it indicates that they will be likely to pay off their debts, both current and long-term, as they become due. The general rule of thumb here is that the debt ratio should be at or below this 60%. So that's just in general. Different industries operate at different debt levels, but for right now, just consider 60% that rule of thumb. And a debt ratio that is greater than 80% is considered high risk. So if 80% or more of your assets were financed through debt, that's a large percentage or a large proportion of your assets. So that makes you more risky or indicates there's risk you may not be able to pay off these debts as they become due. Okay, so I want to go over just a really quick example with like 3 numbers. So hopefully this will help you understand what this ratio is really looking at. So really quick example, we are just starting up our brand new company. And the first thing that we do is to purchase equipment. So we need to have this equipment before we can start our operations. So we have our assets, and that's the equipment that we purchased. Equipment. And it had a value of $1,500. We know our assets need to equal our liabilities plus our owner's equity. So the way that we paid for this equipment, first, we needed to take on a bank loan of $900. And the other way that we did it was we are the owner, we invested money. So we invested $600, and that goes into our capital. So that's the owner investment. We put in $600, we didn't have enough money, so then we financed the rest through the bank. So that gets us our total of $1,500. So this is a liability, a bank loan, because we need to pay the bank back, and capital we know is part of owner's equity. So if we quickly calculate the debt ratio for this, we take our total liabilities, which is $900, and we divide that by our total assets, the $1,500. And this gets us to 60%. So 60% of this equipment was financed by taking on debt, this new bank loan. The other 40% was paid by capital. So we invested that money. So that's what the debt ratio looks like. Looks at. This is a really simple example, but hopefully it helps it make sense that we're looking at what percentage of our assets did we need to take on debt to pay for. Okay, so that was a really quick example. Now let's look at a company that has more going on. So we'll go back to S4-18. And the debt ratio for this company, again, we're looking at total liabilities, and we divide that by total assets. Oops. So for this company, if we look at the balance sheet, Teats Company or Tights Company, however you say it, the total liabilities, all that's showing is total current liabilities. So this company does not have any long-term liabilities, therefore total current equals total liabilities. So this amount is $17,400. And we divide by our total assets. So now we're looking at the $58,400. If we do the math here, we end up with 0.2979. So typically we're going to round to 2 decimal places, so 0.30. And this, remember, we're looking at what percentage. So you would show this as a percent. So 30% of the assets were financed by debt. That is what this is telling us. Okay, so if 30% of the assets were financed by debt, then you kind of have to ask yourself the question, well, so what? What does that mean? And we're doing this ratio to look at how likely the company is to pay off all of their debts as they become due. So remember here we said this general rule of thumb is that the debt ratio should be 60% or less. So 60%, that's kind of the safe range. Anything above it gets a little risky. Anything below it is even safer. So at 30%, this is a strong ratio again, or safe. Strong, it's safe. And we say that this indicates that the company will be able to pay off, oops, I can't talk and write at the same time, indicates the company will be able to pay off all debts as they become due. So the users would calculate this to assess the company and see how they're doing. How likely are they to be able to pay off these debts? So internally, management would calculate something like this because they can see, okay, we're in a safe spot. We're likely to be able to pay off our debts. They may even decide, we think now that because this is such a strong ratio, it's pretty safe. We have lots of room here. Maybe we can actually expand. So we could take on more debt or more liabilities and build our business. So they decide, yep, they want to do this. They go to the bank, so an external user at the bank, and say, we're looking to get a new loan for $20,000. Now the bank, they would request the financial statements, and they would also calculate this debt ratio. They would look and say, okay, you're at 30%. Yeah, we think this means that you will be able to pay off debts. We think it's pretty safe, so we're willing to loan you this additional money to use in your company. If this debt ratio ended up being, let's say, 70%, well, now that is a risky level. That's fairly weak and indicates there's risk that the company won't be able to pay off debts. If that were the case, the bank would look at that and they would say, no, that's too risky. We don't think you can pay off what you already have, so we're not giving you any more debt on top of that. That is the way that these ratios are used. Now, when it comes to interpreting ratios, we've talked about these are a really good aid or a good tool for the users and the decision makers. But it's not very wise to place too much confidence on a single ratio. And you have to ask, which ratio is more reliable than another? So in our case, when we looked at Tights Company, both the current ratio and the debt ratio were quite strong. So they both indicated this company was safe. But there are times when you may have a current ratio that's really strong and the company looks good, but then their debt ratio is really bad and they look like they're quite risky. So what ratio do you rely on? Well, it really is just all about using your professional judgment. So as it says here, it takes time by experienced managers, lenders, and investors to evaluate a company. So you can't just look at one ratio and say, yeah, this company's great. They've got a current ratio. There's various ratios that you can look at. You want to look at them over several years, look at the trends or where something maybe hit a bad turning point. So no single ratio can give you the full picture. And it takes experience and lots of looking at ratios to really understand what they mean and help you to evaluate a company. So for now, we've looked at them. We've had some discussion. It's important to know what's strong and what's safe, and also what is it indicating. So why are we doing these ratios? But I know you're not going to be experts immediately. It does take time, and ratios are a great tool, but it needs practice and looking at these to really understand the full meaning and to have that strong evaluation of a company and be able to determine how they're standing. Okay, so that is the end of Chapter 4. We will go through some more examples in our live class this week. If you have some time before then, I encourage you to practice some questions on MyLab to get you ready for our live class.